Welcome to the Get Real Podcast, your high-octane boost of full-on reality therapy for personal, business, and investing success with your host, Ron Phillips, because somebody's got to tell it like it is.
Hey everybody, welcome back to the Get Real Podcast. Ron Phillips here. I'm a little frustrated just in general with the industry. Then I'm going to take one particular piece of it, and I might do this over a few shows. I don't know. We'll see. But I want to talk about lending today because a lot of people have been waiting on rates to come down. There's so much unbelievably wrong information out there when it comes to lending, interest rates, whether people should wait, whether people should buy, refinance, whatever they're doing. And I know that we've talked about this on the show before. When interest rates were supposed to come down because the Fed cut rates, and what ended up happening is rates went up. And everybody's like, well, what the heck is going on? Rates went up, but the Fed just dropped the rates. The Fed doesn't have any control over mortgage rates. The Fed funds rate is not directly correlated or tied to mortgage rates. And the Fed funds rate is a short-term rate. And it has more to do with, like if you have a line of credit that is in some way attached, there's several different lines of credit that you could have, but somebody's going to comment on this video like, nah, you could get a line of credit attached to something else. Yeah, that's true. But many of you have lines of credit that are indirectly tied to the Fed funds rate, and you're borrowing money at prime, just under prime, or just over prime. Those rates will probably adjust. But mortgage rates are tied to different things. And I don't want to spend a ton of time on this, but when the 10-year Treasury, which is most closely associated with the loans that we do, when that has already kind of baked in an interest rate drop, let's just say that it's baked in a 0.5 point drop, Fed lowers the rate 0.25 point, the Treasury could go up. And because rates didn't drop as much as they thought they were going to, they could be completely unchanged, or they could go down. And none of that really has anything to do with the Fed. It's just what's happening with the 10-year Treasury. I don't want to go into a diatribe about what affects the 10-year Treasury, but there's things that affect the 10-year Treasury, and they're different than the Fed funds rate. But there's a whole lot more to lending that I think you need to understand. There's a lot of layers in between the investor that ultimately funds your loan or buys your loan and the mortgage broker with whom you're working. A lot. There is a lot of money, lots of hands getting paid in between there. I see online a lot that debt service coverage ratio loan rates are in the mid 7s, or they're, even approaching 8. Well, they might be at some places, but we are certainly not seeing those rates. So let me give you a few tips if you're shopping for a rate. Number one, if you're shopping for a debt service coverage ratio loan, which is for investment property, you should just reach out to us, invest@rpcinvest.com. We get the best rates in the country and the lowest fees. Just period. Try me. So if you're refinancing or if you're purchasing, reach out, invest@rpcinvest.com. Because for the last 8 months, we've been working on standing up our own internal lending. I have really had an education on just how many hands are in the proverbial pot. And there's a lot. So a couple of things. If you're shopping for a loan, ask your mortgage broker to quote you par rate. That is the rate. Par is an industry term, but that rate is a zero rate for the brokerage. Okay. So they're supposedly now, they're not piling on a whole bunch of fees and putting it inside of the rate. That should just be what the money costs them at that level. Okay? When you're comparing different mortgages and different terms, you need to make sure you're doing that apples to apples. And the best way to do that is to compare their par rate and then all of the fees that it costs you to do the loan side by side with another mortgage company. Okay? Because this is like the car dealer, right? Where you've negotiated a deal on a car, and then you go into the finance office. And in the finance office, they start manipulating the numbers so that you quote unquote get a better deal, and you don't end up getting a better deal. The car dealership ends up getting a better deal. So when you're asking a mortgage broker, I just want you to quote me par rate, and then I want you to give me whatever you're going to charge me to do the loan separate. Okay, just give me all the fees. Then when you go to the next mortgage broker, everything's on the same page. You can tell whether their par rate is lower or higher. Now, there's some reasons for that. Okay? There's some reasons for that. They may have another, like many mortgage brokers have another brokerage in the middle before it actually gets to the correspondent lender that then goes to the actual money. The more layers you put in there, the more people have to get paid, the higher their par rate goes. The closer you get to the money, the lower your par rate can be. And there's a lot of waste in the industry that we're seeing. A lot of waste. And so what we've been trying to do is figure out how can we cut out all of the waste and get as close to the money as we can possibly get, so that we can get the lowest par rate and then charge the least amount of fees possible. And it makes a massive difference, guys. It makes a massive difference. Understanding what is really going on with loans is usually worth about 1%. About 1% in a rate. And that's insane. That's legitimately insane. It's a lot of money. And then the best rates, terms, programs, that all depends on how many different investors you have access to. If you only have access to a handful, you're going to be hamstrung by what those particular investors will allow on their loans. Having an enormous amount of business that goes to a multitude of different investors. And when I say investors, I mean like the people who are actually buying the loans. Insurance companies, people like that who are on the backside of all of this are the ones who are actually buying these mortgages. Having access to more of them means that you have better competition in between all of the players. And you can, because of the volume, you could actually go in and negotiate better deals. So I'm just telling you, little quick hack or trick, make sure you understand the difference in the rates, terms, programs, and all of that. One more thing I'll tell you. Sometimes, like every one of these investors, their buy down, the cost associated with buying down the interest rate is different. And it can be much less with certain investors for a far greater buy down. So if you have incentives from the builder that you're working with or the seller you're working with, make sure that you are figuring out who has the best interest rate buy down associated with their loans. So all of this is super important, folks. And if you have other questions, just feel free to reach out to us. invest@rpcinvest.com. We have our own internal lending now, and it is not to toot our own horn, but it's pretty good. Until next week, get out there and make something happen.
This has been the Get Real Podcast. To subscribe and for more information, including a list of all episodes, go to getrealestatesuccess.com.